Section 4.1 to 4.3 Fundamental Analysis. 4.1 Discounted Cash Flow, DCF, Analysis. The concept of time value of money, TVM, is a fundamental principle in finance that states that the value of money changes over time due to various factors, such as inflation, opportunity cost, and the ability to earn interest or returns on investments. The underlying idea is that a dollar received today is worth more than a dollar received in the future. This is because money has the potential to grow or earn returns over time. Therefore, a dollar in the present can be invested and earn interest or be used to generate income, making it more valuable than the same amount of money received in the future. There are two main reasons why money has a time value: opportunity cost. When you have money in hand today, you have the opportunity to invest it or use it for various purposes. By doing so, you forego the potential earnings or benefits that could have been derived from that money. Therefore, the value of money today includes not only its intrinsic value but also the potential opportunity it provides. Inflation. Inflation erodes the purchasing power of money over time. The cost of goods and services generally tends to increase over the years, meaning that the same amount of money will buy fewer goods or services in the future. To account for this loss of purchasing power, the value of money in the future is considered to be lower than the value of money today. TVM is the foundation for various financial concepts and calculations, such as present value, PV, future value, FV, net present value, NPV, internal rate of return, IRR, and discounted cash flow, DCF, analysis. These calculations allow individuals and businesses to assess the value of cash flows, investments, loans, and other financial transactions over time, taking into account the time value of money. Understanding the concept of TVM is crucial in making informed financial decisions, such as evaluating investment opportunities, determining loan affordability, and assessing the profitability of projects or business ventures. By considering the time value of money, individuals and businesses can make better financial plans and optimize their financial outcomes. Estimating cash flows, determining discount rates, and calculating intrinsic value are important steps in valuation analysis. Here's an overview of each component. Estimating cash flows. Cash flows are the expected future cash inflows and outflows generated by an investment, project, or company. To estimate cash flows, you typically need to forecast revenues, expenses, and other relevant financial metrics over a specific period, usually several years. Cash flows can include operating cash flows, investment cash flows, and financing cash flows. Accurate and reliable cash flow estimates are crucial for valuation analysis. Determining discount rates. The discount rate, also known as the required rate of return or cost of capital, is used to calculate the present value of future cash flows. It represents the rate of return that an investor or entity expects to earn from an investment given its level of risk. The discount rate takes into account factors such as the risk-free rate of return, the risk associated with the investment or company, and the market's expected return. Determining an appropriate discount rate requires a comprehensive analysis of the investment's or company's risk profile. Calculating intrinsic value. Intrinsic value is the estimated true value of an investment or company based on its expected future cash flows and the chosen discount rate. The most common method used to calculate intrinsic value is the discounted cash flow, DCF, analysis. In DCF analysis, the future cash flows are projected, and then each cash flow is discounted back to its present value using the discount rate. The sum of the present values of the cash flows represents the intrinsic value of the investment or company. The formula for calculating the intrinsic value using DCF analysis is, intrinsic value equals, CF1/1R, 1, CF2/1R, 2. CFN/1R, N, where CF1, CF2, CFN are the expected cash flows in each period, R is the discount rate, and N is the number of periods. It's important to note that estimating cash flows, determining discount rates, and calculating intrinsic value involve a degree of subjectivity and uncertainty. Different valuation methods and assumptions can lead to different results. Sensitivity analysis and scenario testing can be useful in evaluating the impact of varying cash flow projections and discount rates on the intrinsic value. valuation is both an art and a science, and it requires a deep understanding of the investment or company being analyzed, industry dynamics, and market conditions. It's often helpful to compare the calculated intrinsic value with the current market price to assess whether the investment is undervalued or overvalued, providing insights for investment decision-making. Sensitivity analysis is a technique used to assess the impact of changes in key variables or assumptions on the results of a financial model or valuation analysis, such as a discounted cash flow (DCF) analysis. It helps evaluate the sensitivity of the valuation to different scenarios and provides insights into the potential risks and uncertainties associated with the valuation. Here's how sensitivity analysis can be applied in interpreting DCF results. Identify key variables. Start by identifying the key variables or assumptions that have a significant impact on the DCF valuation. These variables can include cash flow projections, discount rates, growth rates, and terminal values. The selection of key variables depends on the specific context and characteristics of the investment or company being analyzed. Define scenarios. Create different scenarios by varying the values of the key variables. For example, you can create a base case scenario with the most likely values, and then develop optimistic and pessimistic scenarios by adjusting the variables upward or downward. It's important to ensure that the scenarios are plausible and reflect potential changes in market conditions, industry dynamics, or company-specific factors. Assess the results. Calculate the intrinsic value of the investment or company under each scenario using the DCF model. Compare the results to understand the sensitivity of the valuation to changes in the key variables. Analyze how the changes in variables impact the overall value and determine whether the investment remains attractive or becomes less favorable in different scenarios. Interpret the findings. Interpret the findings of the sensitivity analysis in the context of the investment decision. Determine which variables have the most significant impact on the valuation results. Assess the potential risks and uncertainties associated with these variables and consider their likelihood and potential implications. This analysis helps in understanding the robustness of the valuation and provides insights into the range of possible outcomes. Mitigate risks. Based on the findings of the sensitivity analysis, develop strategies to mitigate the identified risks and uncertainties. This can include implementing risk management measures, adjusting the investment thesis or assumptions, or exploring alternative scenarios. By addressing the risks identified through sensitivity analysis, you can make more informed and prudent investment decisions. It's important to note that sensitivity analysis provides insights into the impact of changes in specific variables, but it cannot predict future outcomes with certainty. The results should be interpreted in conjunction with qualitative factors, market conditions, and other relevant information. Sensitivity analysis is a tool for understanding the potential range of outcomes and managing risks in the decision-making process. Overall, sensitivity analysis enhances the understanding of the valuation model's sensitivity to changes in key variables and enables more robust decision-making by considering different scenarios and their potential implications. 4.2 Comparable Company Analysis, CCA. Identifying comparable companies and conducting benchmarking analysis is a common practice in financial analysis and valuation. It involves selecting companies that are similar to the one being analyzed and comparing their financial and operational performance to gain insights into the company's relative position and performance within its industry. Here's an overview of the process of identifying comparable companies and performing benchmarking analysis. Industry classification. Start by identifying the industry or sector in which the company operates. Industry classifications, such as the Global Industry Classification Standard, GICS, or Standard Industrial Classification, SIC, can provide a framework for grouping companies based on their primary business activities. Company characteristics. Identify key characteristics that define the company you are analyzing, such as size, geographic location, product or service offerings, market position, and growth prospects. These characteristics will help narrow down the universe of potential comparable companies. Selection criteria. Determine the criteria for selecting comparable companies. Common selection criteria include industry peers, companies with similar business models, similar market capitalization, revenue size, geographic location, and operational metrics. The selection criteria will depend on the specific context and purpose of the analysis. Financial and operational data. Gather financial and operational data for the selected comparable companies. This can include financial statements, key performance indicators, KPIs, market data, industry reports, and other relevant information. Data sources can include company filings, financial databases, industry publications, and market research reports. Financial metrics for comparison. Identify relevant financial metrics and ratios for comparison. These can include profitability ratios, example, gross margin, operating margin, net profit margin, liquidity ratios, example, current ratio, quick ratio, leverage ratios, example, debt-to-equity ratio, interest coverage ratio, growth rates, and other performance indicators. Ensure that the financial metrics selected are appropriate and meaningful for the industry and company being analyzed. Benchmarking analysis. Compare the financial and operational performance of the company being analyzed to the selected comparable companies. This can be done by calculating and comparing the financial ratios, growth rates, and other performance metrics. Consider both absolute values and relative performance to assess how the company compares to its peers and industry averages. Interpretation. Interpret the benchmarking analysis results to gain insights into the company's relative performance, strengths, and weaknesses. Identify areas where the company outperforms its peers and areas where improvement may be needed. Consider qualitative factors and other contextual information to understand the reasons behind the performance differences and to draw meaningful conclusions. Benchmarking analysis provides a relative perspective on a company's performance and helps identify areas for improvement or opportunities for growth. It can be useful in assessing a company's competitive position, identifying best practices, and setting performance targets. However, it's important to consider the limitations of benchmarking, such as differences in business models, strategies, and market dynamics among the compared companies. Analyzing valuation multiples, such as price-to-earnings, P/E ratio, price-to-sales, P/S ratio, and others, is a common method used to assess the relative value of a company's stock compared to its financial performance. These multiples provide a quick way to compare a company's market price to a specific financial metric and are widely used in the investment community. Here's an overview of some key valuation multiples. Price-to-earnings, P/E ratio. The P/E ratio is one of the most widely used valuation multiples. It is calculated by dividing the market price per share by the earnings per share, EPS. The P/E ratio reflects the market's expectation of a company's future earnings growth and investors' willingness to pay for each dollar of earnings. A higher P/E ratio indicates that investors are willing to pay a higher price relative to the company's earnings, suggesting a higher expectation of future growth or market optimism. Conversely, a lower P/E ratio may indicate lower growth expectations or market pessimism. Price-to-sales, P/S ratio. The P/S ratio is calculated by dividing the market price per share by the company's revenue per share. It measures the market's valuation of a company's sales or revenue. The P/S ratio is often used for companies with negative or volatile earnings, as it provides a valuation based on the company's revenue generation. A higher P/S ratio suggests that investors are willing to pay more for each dollar of sales, indicating higher growth expectations or market optimism. A lower P/S ratio may indicate lower growth expectations or market pessimism. Price-to-book, P/B ratio. The P/B ratio compares the market price per share to the company's book value per share. The book value represents the net assets of a company, total assets minus total liabilities. The P/B ratio indicates the market's valuation of a company's net assets. A P/B ratio greater than 1 suggests that the market values the company's assets at a premium, indicating potential growth opportunities or market optimism. A P/B ratio less than may first indicate that the market values the company's assets below their book value, suggesting potential undervaluation or market pessimism. Enterprise value to EBITDA, EV/EBITDA ratio. The EV/EBITDA ratio compares a company's enterprise value, market capitalization plus debt minus cash, to its EBITDA, earnings before interest, taxes, depreciation, and amortization. It is commonly used in assessing the valuation of companies with high debt levels or significant depreciation and amortization expenses. The EV/EBITDA ratio provides a measure of the company's overall value relative to its earnings power. A lower EV/EBITDA ratio may indicate a relatively cheaper valuation, while a higher ratio may suggest a higher valuation. Dividend yield. The dividend yield represents the dividend paid per share divided by the market price per share. It measures the income generated by an investment in the form of dividends. The dividend yield is often used by income-oriented investors to assess the attractiveness of dividend-paying stocks. A higher dividend yield indicates a higher return on investment in the form of dividends, while a lower yield suggests a lower return. It's important to note that valuation multiples should not be used in isolation but should be considered along with other financial and qualitative factors. The interpretation of valuation multiples depends on the industry, company-specific characteristics, growth prospects, and market conditions. It's also essential to compare the multiples of a company with its peers and industry averages for a meaningful analysis. Valuation multiples provide a snapshot of the market's perception of a company's value based on specific financial metrics. They serve as a starting point for further analysis and should be used in conjunction with other valuation methods and considerations to make informed investment decisions. The capital cost allowance, CCA, method is a commonly used approach for calculating tax deductions on depreciable assets in Canada. Here are some pros and cons associated with the CCA method. Pros: tax deduction. The CCA method allows businesses to claim tax deductions on the depreciation of their assets. This helps reduce taxable income and lowers the amount of taxes owed, providing potential tax savings for businesses. Flexibility in asset classes. The CCA method provides flexibility in categorizing assets into different classes with specific rates of depreciation. This allows businesses to align the depreciation rates with the useful lives of their assets more accurately. Cash flow management. By claiming CCA deductions, businesses can potentially improve their cash flow. The tax savings resulting from the CCA deductions can be reinvested in the business or used for other purposes. Incentive for investment. The CCA method encourages businesses to invest in capital assets by providing tax incentives. This can stimulate economic growth and encourage businesses to upgrade or expand their asset base. Cons: complexity. The CCA method involves complex calculations and requires businesses to keep detailed records of their assets, including purchase dates, costs, and applicable depreciation rates. This can add administrative burden and increase compliance costs for businesses. Timing of deductions. The CCA method follows specific rules and schedules for claiming deductions, which may not align with the actual economic depreciation of assets. This can lead to timing differences between the tax deductions and the actual decline in the value of assets. Impact on financial statements. The depreciation calculated using the CCA method may not accurately reflect the true economic value or the useful life of the assets. This can affect the financial statements, as the reported value of assets and net income may not align with the economic reality. Limited tax benefit. While the CCA method provides tax deductions, it does not eliminate the tax liability entirely. The tax savings from CCA deductions are subject to the applicable tax rate, so the actual benefit may be lower than the face value of the deductions. Potential for errors. Due to the complexity of the CCA calculations, there is a risk of errors or incorrect classification of assets, which can result in tax penalties or adjustments during tax audits. It's important for businesses to understand the rules and guidelines of the CCA method, consult with tax professionals, and maintain accurate records to ensure compliance and maximize the tax benefits associated with the method. 4.3 Dividend Discount Model, DDM, valuing a company based on future dividend cash flows is one approach to valuation known as the Dividend Discount Model, DDM. The DDM estimates the intrinsic value of a company's stock by discounting the expected future cash flows in the form of dividends to their present value. Here's an overview of the process. Forecast dividends. Begin by forecasting the future dividends the company is expected to pay. This involves analyzing the company's historical dividend payments, dividend policy, earnings growth projections, and other relevant factors. The forecasted dividends should be realistic and based on reasonable assumptions. Determine the required rate of return. Establish the required rate of return or discount rate that represents the investor's required return on investment. The discount rate reflects the risk associated with the investment and is often determined by considering factors such as the risk-free rate of return, the company's systematic risk, beta, and the market risk premium. Calculate the present value of dividends. Discount each forecasted dividend to its present value using the discount rate determined in the previous step. The present value calculation involves dividing each future dividend by the appropriate discount rate based on the time period it is expected to be received. Sum up the present values of all forecasted dividends to obtain the total present value of dividends. Determine terminal value. Beyond the forecasted period, estimate the terminal value, which represents the value of the company's future dividends beyond the forecast period. This can be done using methods such as the Gordon growth model, which assumes a constant growth rate for dividends. The terminal value is calculated by dividing the expected future dividend at the end of the forecast period by the difference between the discount rate and the assumed constant growth rate. Sum present value of dividends and terminal value. Add the present value of dividends obtained in Step 3 to the terminal value calculated in Step 4 to obtain the total intrinsic value of the company. Assess sensitivity and risks. Perform sensitivity analysis by varying the key assumptions, such as the growth rate, discount rate, and dividend projections, to understand the impact on the calculated intrinsic value. Consider the risks and uncertainties associated with the forecasted dividends, such as changes in the company's earnings, dividend policy, and market conditions. It's important to note that valuing a company based on future dividend cash flows using the DDM has limitations. It assumes that the company pays dividends, has stable dividend growth, and accurately predicts future cash flows. Additionally, the DDM may not be suitable for companies that do not pay dividends or have unpredictable dividend patterns. Therefore, it's advisable to consider other valuation methods and qualitative factors to gain a more comprehensive understanding of a company's value. Estimating dividend growth rates and the required rate of return is crucial in valuing a company using the dividend discount model, DDM. Here are some methods and factors to consider when estimating these values. Dividend growth rate. A. Historical growth. Analyze the company's historical dividend growth rates over a relevant period. Calculate the compound annual growth rate, CAGR, to determine the average growth rate. B. Industry growth. Consider the growth rates of comparable companies within the same industry to get an idea of the industry's average growth rate. C. Future outlook. Assess the company's growth prospects, earnings potential, market conditions, competitive landscape, and any upcoming factors that may impact dividend growth. Consult industry reports, financial analysts, and the company's management for insights. Dividend payout ratio. Historical payout ratio. Evaluate the company's historical dividend payout ratio, which measures the proportion of earnings paid out as dividends. Determine if the company maintains a stable or fluctuating payout ratio over time. B. Sustainable payout ratio. Consider the company's ability to sustain the current dividend payout ratio. Evaluate the company's profitability, cash flow generation, and capital expenditure requirements. A sustainable payout ratio ensures that the company can maintain dividend payments without compromising its financial health. Required rate of return. Risk-free rate. Determine the risk-free rate, typically based on government bond yields with a similar maturity to the investment horizon. B. Equity risk premium. Assess the additional return investors require for bearing the risk of investing in equities. The equity risk premium compensates for the higher volatility of stocks compared to risk-free assets. C. Beta. Estimate the company's beta, which measures its sensitivity to market movements. A higher beta indicates a higher level of systematic risk. Beta values can be obtained from financial databases or calculated based on historical stock price data. D. Cost of debt and equity. If available, consider the company's cost of debt and equity, which can be obtained from the company's financial statements or market data. Weighting factors. Weighing dividend growth rates. Depending on the forecasted period, assign appropriate weights to historical growth rates, industry growth rates, and future growth expectations. Give more weight to recent and reliable data. B. Weighting required rate of return. Consider the company's specific risk profile and adjust the required rate of return based on factors such as business risk, financial risk, and market conditions. Remember that these estimates involve uncertainties, and it's important to apply judgment and consider multiple scenarios. Sensitivity analysis can help understand the impact of different dividend growth rates and required rates of return on the valuation results. Additionally, professional advice from financial analysts or valuation experts can provide valuable insights and ensure a more accurate estimation of these values. The dividend discount model, DDM, is a valuation method that estimates the intrinsic value of a company's stock based on the present value of expected future dividends. However, it has several limitations and assumptions that should be taken into consideration. Dividend assumption: the DDM assumes that the company pays dividends to its shareholders. This assumption may not hold for all companies, especially those that reinvest their earnings for growth or choose to repurchase shares instead of paying dividends. Dividend growth rate: the DDM assumes a constant or predictable dividend growth rate. Estimating future dividend growth can be challenging, and unexpected changes in the company's earnings or dividend policy can significantly impact the valuation results. Required rate of return: the DDM relies on the estimation of the required rate of return or discount rate. Determining an appropriate discount rate involves assumptions about risk, market conditions, and investor expectations. Different analysts or investors may have varying opinions on the appropriate discount rate, leading to different valuation outcomes. Simplified cash flow stream: the DDM only considers the cash flows in the form of dividends and does not account for other potential sources of value, such as share buybacks, acquisitions, or changes in capital structure. This simplification may overlook important factors that can influence the overall value of the company. Lack of consideration for residual value: the DDM typically assumes a finite forecast period for dividends. However, in reality, companies can continue generating cash flows beyond the forecasted period. Failing to account for the residual value can lead to an incomplete valuation. Sensitivity to assumptions: the DDM is sensitive to changes in key assumptions such as dividend growth rate, required rate of return, and dividend payout ratio. Small variations in these assumptions can have a significant impact on the estimated intrinsic value. Lack of consideration for market dynamics: the DDM assumes that the stock price will converge to the intrinsic value estimated using dividends. However, market dynamics, investor sentiment, and other factors can lead to deviations between the stock price and the DDM valuation. Limited applicability: the DDM is more suitable for mature, stable companies with a consistent dividend payment history. It may not be suitable for companies in the growth phase or those with irregular dividend patterns. It's important to recognize these limitations and consider the DDM as one of many valuation methods. Using multiple approaches and considering qualitative factors can provide a more comprehensive understanding of a company's value.